On April 14th, Congress passed the largest banking change in 100 years. The mainstream press buried it. It rewrites how money moves through your account and others and clears a path for the first bank issued stablecoin. The dollars in your account will never be the same. Here is the full story.
On July 18th, 2025, Trump signed the most important crypto law in American history, the Genius Act, the first federal law to ever comprehensively regulate a digital asset. The first new category of money Congress has created since the Federal Reserve Act of 1913, 112 years ago. The biggest single legal change to American banking since the 1933 Glass-Steagall Act. If you hold Bitcoin, if you hold Ethereum, if you hold any stablecoin, if you have a checking account at a U.S. bank, and you don't understand what this law does, you are going to be on the long side of the largest restructuring of American money since the Euro-dollar market formed 70 years ago. I want to be direct about how big this is. Stablecoin transaction volume in 2024 was $27.6 trillion. That surpassed Visa and MasterCard combined. The current stablecoin market is roughly $300 billion outstanding. Standard Chartered projects that hits $2 trillion by end of 2028. JP Morgan and Bank of America are both building stablecoin products right now. Circle, Paxos, and 3 other non-bank issuers received federal trust bank charges in December. The OCC issued its proposed rulemaking in February. The law takes full effect on January 18, 2027, 8 months from today. This breakdown is your warning. Watch this video to understand what the law actually does, why every major bank is building inside its framework right now, and the warning clause inside this law that the country's leading bankruptcy academics have publicly said does not work the way Congress described it. If you hold any digital asset and you do not understand this, you are unprepared for the rails the institutional money is about to ride on. The Genius Act. Full name, Guiding and Establishing National Innovation for U.S. Stablecoins. Senate passed at 68-30 on June 17th. House passed at 308-122 on July 17th. Bipartisan. The bank lobbies supported it. The crypto industry supported it. Consumer Reports opposed it. The bill passed anyway. The law creates a new category of money. It looks like a dollar, moves like a dollar, backed 1-to-1 by U.S. Treasury bills of 93 days or less, physical currency, or reversed repurchase agreements. Not a bank deposit, not FDIC insured, not a security, not a commodity. A new category that sits alongside everything else without falling under any of the existing protection frameworks. That is the trap. The OCC granted National Trust Bank charges to Circle, Paxos, and 3 other non-bank firms in December 2025. Bank of America and JP Morgan are both developing stablecoin products right now. The bank that holds your checking account is about to become a stablecoin issuer. There is one clause in this law that nobody in the press is reading. Section 11. It amends the U.S. Bankruptcy Code directly. It says stablecoin holders get priority over all other claims against the issuer in an insolvency. That language is what was used to sell this bill as consumer protection. That's the part everyone repeated. That's the part that doesn't work. By law, stablecoin issuers cannot pay interest or yield to holders. A stablecoin is a payment instrument, not a savings product. This matters because the bank issuing the stablecoin collects the yield on the Treasury reserves backing it and keeps it. At $300 billion in stablecoins outstanding today, at 4 to 5% Treasury yields, that's $12 to $15 billion a year flowing to the issuers. That $2 trillion in stablecoins by 2028, that's $80 to $100 billion a year. The consumer earns nothing on the underlying Treasury that's funding the issuer's income. The no-interest rule was sold as consumer simplicity. The actual function is to protect the issuer's revenue model. The Treasury yield is the business. Here's the second piece. The Federal Reserve Bank of Kansas City published a paper in August by economist Stefan Jankwitz. If consumers move money from their checking accounts into bank-issued stablecoins, the bank loses its deposit funding. The bank then has 2 choices. Pay higher interest to suit the deposits it still has, which reduces bank profits, or reduce lending to the real economy, which reduces credit supply to small businesses and homeowners. The Treasury Borrowing Advisory Committee acknowledged this directly in their July 2025 report, quote, "Potential impact to bank deposits bears close monitoring." That's the Treasury Department itself flagging the issue. If you've made it this far, here's why this hits your wallet. The community bank in your area is already under pressure from commercial real estate stress. 60 banks were on the FDIC problem list as of fourth quarter 2025. 2 banks have already failed this year. When stablecoin growth pulls funding out of community banks, the failure pace accelerates. The bank that's most likely to fail is the one without a stablecoin product to offer. The bank that survives is the one that already built the new instrument. The Genius Act doesn't just create a new payment system. It consolidates banking power toward the institutions large enough to issue. Now back to Section 11, the bankruptcy clause. The bankruptcy professoriate read the actual statute. Bob Lawless at the University of Illinois, Adam Levitin at Georgetown, and a working group of the country's top bankruptcy academics published a legal analysis on the blonde credit slips on December 2nd, 2025. Their finding, quote, holders of payment stablecoins actually will rank fifth in a bankruptcy distribution. Read that again? Fifth. Here's how the trap works. When a stablecoin issuer goes bankrupt, the bankruptcy code lets a debtor in possession lender, typically a distressed debt fund or a Wall Street bank, extend new financing to the insolvent issuer.
Hey everyone, real quick, sorry to break in, but if you're even thinking about buying a cryptocurrency or you're pretty new the last few years and you want to learn how to secure it properly, invest it properly, just do everything other than save money and sell at a loss, the link down below is for two courses, the Bitcoin and XRP 101 course and the crypto security course, complete game changer. I want to make sure that you do not lose your money to a hack, to a vulnerability, to anything outside of what you want to do with your crypto. Links down below. It's going to save you a lot of time and money. Now let's get back to the video.
The DIP lender gets a first priority lien over all the issuer's assets, including the Treasury reserves Congress thought it was protecting for the consumer. The DIP lender's lawyers then negotiate a fee carve-out for the bankruptcy professionals. Then the issuer's depository banks get set off claims on cash held in transit accounts. By the time the priority for stablecoin holders kicks in, 4 classes of sophisticated creditors have already taken their slice. The Consumer Protection Clause was published. The press repeated it. The law was sold on it. The bankruptcy lawyers who write this code for a living are publicly saying it doesn't work. The historical parallel matters. In 1933, Congress passed Glass-Steagall to separate commercial banking from investment banking. In 1999, Grand-Leach-Bliley repealed that separation. 18 months later, the dot-com crash. 8 years later, the 2008 financial crisis. The argument from critics of both Grand-Leach-Bliley and Genius is identical. When you create new categories of financial activity inside the banking system without the full protection infrastructure of the banking system, you create new vectors for systemic risk nobody has stress tested. You already sense where this goes. The MIT Digital Currency Initiative ran the math in February. If there's a complete run on Circle and Tether today, their forced selling of Treasury reserves represents roughly 20% of daily turnover in the entire U.S. Treasury market. UC Berkeley economist Barry Eichengreen put it plainly, quote, if panicked customers force stablecoin issuers to sell the Treasuries backing stablecoins, Treasury prices could collapse, sharply increasing interest rates and destabilizing other financial markets and our entire economy. The instrument sold as the safer alternative is the same instrument that could trigger the next Treasury market crisis. And stablecoin issuers don't have direct access to the Fed discount window. There's no lender of last resort wired into the Genius Act framework. Now to what you do. The MAR takes effect January 18th, 2027, 8 months from now. The bank holding your money is going to offer you a stablecoin product. The marketing will say it's faster, programmable, and safer. The speed and programmability are true. The safer part depends on which lawyer wrote the bankruptcy section. Don't move uninsured savings into a stablecoin until you've read the bankruptcy treatment in the issuer's disclosure. The legal opinions are public. Credit slips December 2nd, 2025. Search Genius Act Bankruptcy Fifth Priority. The country's leading bankruptcy academics laid out exactly which classes of creditors come ahead of you. Keep insured deposits where they are. The $250,000 FDIC line is still the strongest protection in American banking. The stablecoin doesn't replace the deposit. The stablecoin is what your bank wants you to use because the bank earns the Treasury yield on it. And watch the OCC final rule when it drops. The proposed rulemaking is February 25th, 2026. The final version will determine which specific safeguards make it into the implementation. The version Congress passed and the version the regulators implement are not always the same thing. Now you know where the exits are. There's one more thing inside Section 11 that I haven't told you. The same section that creates the bankruptcy priority also requires the comptroller of the currency to appear in every stablecoin issuer bankruptcy case. regardless of whether there's anything for the OCC to add. The controller of the currency, the agency that approved Circle and Paxos in December 2025, is the agency now required by law to participate in those issuers' insolvency proceedings. The controller of the currency, the agency that approved Circle and Paxos in December 2025, is the agency now required by law to participate in those issuers' insolvency proceedings. Read Section 11 yourself. The statute is public. The legal analysis is public. The implementation date is on the calendar. 8 months. Economic Ninja is out. Stay vigilant and watch the rails for future updates.